Sooner or later, you run the same quiet calculation in your head. How much would you need invested so the income alone pays for your life? A portfolio big enough that you never sell a share. You never touch the core. The money just arrives month after month while you spend your day however you want. It's a beautiful idea, and it's completely possible. But almost nobody answers the real question honestly, not the fantasy number, the real one. Because living off dividends was never just about owning the right stocks. You need enough capital, enough yield, enough growth, and enough income left after tax to survive real life. Get one of those wrong, and the dream stops working. So let's build that number together, step by step. And it starts with a piece of math that's simpler than you'd expect. To live off dividends, you really only need one thing to be true. Your portfolio's income has to cover your spending. So the formula is almost too simple. Take your yearly expenses, divide them by your dividend yield. The easiest way to see it is with a quick example. Say you want $40,000 a year to live on. If your portfolio pays a 4% yield, you need $1 million. That's the number most people carry around in their head. But that number hides the first problem with the dream, because a 4% yield assumes a portfolio built specifically for income. The broad market doesn't pay anything close to that. Think about what most beginners actually own. Usually it's a simple index fund that tracks the whole market, and a fund like that isn't paying you 4%. Right now it pays around 1%. That's one of the lowest levels in modern history. Watch what that does to the math. The same $40,000 lifestyle no longer needs $1 million. It needs around $4 million instead. Same lifestyle, but 4 times the capital. The yield you choose doesn't change how you live. It changes your finish line by millions. And that one gap is what pushes people straight into their first real mistake. They go hunting for higher yield. At first, that hunt feels completely logical. If a higher yield shrinks the number, you just buy higher yields. Find something paying 8 or 9%, and suddenly you need a fraction of the money. That is the yield mirage, and it's the first trap between you and your number. Here's what the mirage hides. A yield is just a fraction, the dividend divided by the price. So a yield can jump for 2 completely different reasons. The company raised its dividend, that's good. Or the share price collapsed, and that's the warning sign. Most sky-high yields are the second kind. The market isn't being generous. It's pricing in danger. Take Intel. For decades, it was a steady, trusted dividend payer, the kind of name people felt safe holding for income. Then the business started to struggle. The stock fell, and as it fell, the yield only looked more and more tempting on a screen. In 2024, Intel suspended its dividend completely. Anyone who bought it just for that income got hit twice. The dividend vanished, and the share price had already crumbled under them. A high yield is not a reward. Sometimes it's the market screaming that something is wrong. So chasing yield is dangerous. But let's say you avoid the mirage completely. You buy only healthy, reliable payers. Even then, a deeper illusion is waiting for you, and it's hiding inside the word income itself. Quick thing before we keep going. If this kind of video helps you make sense of money, please consider subscribing. It really does make a huge difference for a new channel like this. Thanks. Now let's get back to building the number. That illusion sits inside a belief almost everyone holds without ever checking it. The belief that a dividend is extra money, a bonus, free cash landing on top of your investment. It really does feel that way. The cash shows up in your account. Your shares are still sitting there. Nothing looks like it left. But that's not what actually happened. When a company pays a dividend, it hands out part of its own value. Around what's called the ex-dividend date, the share price usually drops by roughly the amount paid. So the money didn't appear from nowhere. It moved out of the value of your shares and into your account. A dividend isn't extra money on top of your investment. It's part of your investment being handed back to you. Now, I need to be clear here because this is where people overcorrect. This does not make dividends bad. Dividends are not a scam. They are not a trick. They're simply one clean, reliable way to turn a portfolio into cash flow. The danger was never the dividend. The danger is misreading it, believing your portfolio can pay you forever while the total value somehow never matters. Because the thing that actually builds your wealth is total return. The price growth and the dividends together, not the dividend on its own. If you've ever felt richer the second a dividend hit your account, that feeling was the illusion doing its job. And once you see it, the real question changes. It's no longer how big is my income? income. It's whether that income will still be enough years from now. That's exactly where the next trap goes to work. To see why that question matters so much, imagine your portfolio finally pays you $40,000 a year, enough to cover your life. It feels like the hard part is over, and that feeling of safety is the trap because your expenses don't sit still. Prices creep up every single year. Rent climbs, groceries climb, insurance climbs, quietly in the background. So a fixed income doesn't really stay the same. In real terms, it shrinks. At a normal rate of inflation, prices roughly double over about 25 years. That means the $40,000 funding a comfortable life today might cover only half of that life by the time you're older. Same income on paper, half the life in reality. This is why a high starting yield can be its own kind of trap. A lot of the highest payers barely grow their dividend at all. What you actually want is income that rises over time. Companies that lift their payout year after year, ideally faster than prices rise. A frozen income isn't actually safe. It slowly melts year after year. So the real target was never just a number. It was a number that grows. But even a growing income has a silent partner. Someone takes a cut before you ever spend a dollar. That silent partner is tax. So let's go back to that $40,000 of dividend income. There's the number you see on your statement, and there's the number that actually reaches your bank account. They are not the same. The gap between them is tax. In most countries, dividend income gets taxed. So if your portfolio pays $40,000, you don't get to spend all $40,000. A slice is taken before it ever reaches you, and that changes your target. If part of every dividend goes to tax, you need a bigger portfolio just to end up with the same amount to live on. There's one more layer most people never think about. Where you hold your investments can matter as much as what you hold. The exact same portfolio, sitting in a regular brokerage account versus a tax-advantaged retirement account, can hand you very different amounts of real, usable cash. The rules change from country to country, so this isn't about one nation's tax code. It's about a principle that applies everywhere. You don't live on what your portfolio earns. You live on what survives the tax. So now we can strip everything away. The mirage, the illusion, inflation, tax, and finally see what number is actually left standing. It turns out there isn't one number. There are a few, and each one tells a different version of the truth. Start with that same life, $40,000 a year. First, the napkin number. At a 4% yield, you need about $1 million. That's where most people start and stop. But we now know 4% usually means leaving the broad market behind and building specifically for income. So build it more safely instead. Use reliable companies that grow their dividend over time. Their starting yield is lower, usually around 2 to 3% depending on the portfolio. That pushes the number to somewhere between $1.3 and $1.7 million depending on tax, dividend growth, and how much safety margin you want. Then there's a second path entirely, the total return route. Instead of living only on dividends, you sell a small, fixed slice of your portfolio each year alongside them. A common guideline is to withdraw around 4% of your portfolio a year, adjusted for inflation. It comes from research first published in 1994, a rule of thumb pulled from history, not a mathematical promise. More cautious investors often use a slightly lower number. On that approach, $40,000 a year points back toward roughly $1 million again, but now you're no longer untouchable. You're spending the core, slowly, on purpose. So the honest answer was never one clean figure. It can be around $1 million if you use a total return withdrawal strategy. It can sit between 1.3 and 1.7 million if you build around safer dividend growth, and it can climb toward $2 to $4 million if you want pure income from a broad, low-yield portfolio. Not a single magic number, a target shaped by your risk, your growth, and your tax. Living off dividends isn't a number you hit, it's a structure you build. And the people who actually get there almost never arrive the way you'd expect, because the dream you started with was never wrong. It was just misunderstood. The goal was never income that feels free. Free income doesn't exist. The real goal is a structure strong enough that the income keeps arriving anyway. When yields fall, when prices rise, when the tax bill shows up, that's why the path looks the way it does. You build first. You reinvest everything. You let the portfolio grow far bigger than feels necessary. Then, slowly, you shift toward durable growing payers. And only then do you start living on what it produces. So the dream isn't wrong. The mistake is thinking the dividend is the dream. It isn't. The dividend is only the output. What you're really building is a machine. So when you ask how much you need, listen to what you're really asking. You're not buying a paycheck. You're building the machine that keeps paying you long after you stop feeding it. Before you go, I'm curious, and be honest in the comments. Up to now, were you chasing the highest yield you could find? Or were you already building for the long game? And what made you lean that way? There's no wrong answer. Almost everyone starts in the first camp. If you want the simplest engine for the kind of portfolio we just described, watch this next. It breaks down index funds from zero. That's where the machine actually starts. I'll see you there.